The worst mistake stock market investors make. A lot of you enjoy when I do those videos talking about mistakes for stock market beginners or stock market investors in general. Last one was don't hold forever. A lot of you enjoyed this one. This is a much better one. It's probably my most important video ever. It's gonna save you a lot of money on books. It's gonna save you a lot of money on courses because this is, I truly believe, and I've seen it all over amongst my friends, amongst people in my own Discord, over 500 members that join. I have people on Twitter I interact with, people on YouTube, in the YouTube comments specifically. 95% of them, they make this specific mistake. And the best part is, I used to make this mistake too. And I had a sharp pullback in 2018, and I learned it the hard way. Most of what I learned them the hard way. And that's why I try to do those videos so I could help you out instead of you losing money and learning this mistake the hard way. But 95% of people make this mistake. And once you stop making it, your returns will improve dramatically. And this is what I personally experienced. When I stopped making this mistake, everything has changed. In 2020, it was the best year of my life. I made 147% in 1 year. It was stunning. 2021 wasn't too bad. I made 29%. S&P was 28, nothing crazy. 2022, I made 27%. And all that stuff is documented with trade and everything in my own group if you're interested. 2023, I made 28%. And so far this year, I'm up 50% year to date. All because I was able to avoid this one specific mistake that 95% of investors make. So it's gonna be a very deep one. I hope you enjoy it. I hope you get some value out of it. If you do, please let me know in the comments if you agree with me, and let me know what you think in general. And this will be the reason why I named my channel The Patient Investor, not because I hold stocks for 20 years, but you're gonna find out the reason here very soon. Okay, now we all have, I would say, our favorite Buffett videos. Maybe you have your favorite Buffett video or Buffett book. And this is by far my favorite Warren Buffett video. And this is Warren Buffett on real estate investing. Now you might be surprised. What are you talking about? We're talking about stocks over here. Why are you giving me a real estate investing video? Well, just go and watch it. It's going to be mind-blowing. But this is someone that asked Buffett why you don't like real estate investing. And Buffett said he does not like real estate investing because before someone makes a real estate transaction, before someone goes and buys a house, they do a lot of research. They compare it to other homes in the market. You have a bank. The bank will do an appraisal. He will value the house or the property for you to make sure you're getting it at a fair value for the loan. And then you have the inspector that's inspecting the home. So you have a lot of research involved. And because there's a lot of research involved, there's very little room for any major mispricing in real estate. It doesn't mean it doesn't happen sometimes, but it's very hard to do. But the opposite is in the stock market. It's the exact opposite. Because in real estate investing, people invest based on research. In stocks, people invest based on emotions. And if people did not invest based on emotions, you would not have mistakes. You wouldn't have mispricings to take advantage of. And this is for the people that believe the market is rational and the market should act based on news, meaning people believe if the stock beats on earnings, the stock has to go up. If it misses on earnings, the stock has to go down. If the stock is going down, there has to be some kind of news why it's going down. People always look for the news, When the stock is going up, they look for the news of why the stock is going up. And that's why you're doing the stock market completely wrong. Because investors, they don't invest based on logic. They invest based on emotions. And this is why on August 5th, based on JP Morgan's data, on August 5th, the bottom for this year in the stock market, retail investors sold $1 billion worth of stock, while institutional investors have purchased $14 billion. 14 billion, and retail investors sold $1 billion when they should have been buying. And I wasn't selling back then. I bought a stock called CEG. It's up 55% in 3 months. I'm not doing this to show off, but I actually practice what I preach. And I learned it the hard way in 2018. And that's what I'm trying to help you guys. And the main reason why investors sold the bottom, the main reason why we have such selling is because most investors, they don't know what they own. And this is something that Peter Lynch said. He said, know what you own and know why you own it. The main reason why you freak out when the stock is down 5% pre-market or whenever the stock is up 5% after market. The main reason why you freak out before earnings, you freak out on some analyst estimates, you freak out on what's happening if the Fed is going to cut or is going to raise interest rate, if on August 5th we're going to go down because of Japan and it's going to be the next 2000. The main reason why you're freaking out is because you don't know what you own. You haven't done enough research. You don't have a thesis on the company for the next 10 years. If you own Palantir and you owned it from, let's say, $10 per share, now it's sitting, I think, at $40 per share, the main reason you were able to hold is because you have a 10-year vision on the stock and you weren't paying attention to the price to tell you if you're right or wrong. You were paying attention to the fundamentals, and the fundamentals were telling you, is Palantir still growing? Is Palantir still putting up free cash flow numbers? Are they still investing for the future? This is the metrics you track. You do not track the price, you track the fundamentals. But most people, they don't have confidence, they don't know what they own, so they wait for the market to tell them if they are right or wrong. They want feedback from the market. If they buy the stock, it goes up 5%, they feel good because they might be right. But if it goes down 5%, then they start looking for news on why the stock went down 5%, and they believe they are wrong. They start to panic. They don't know what to do. It goes down another 5%. They believe they're the worst ever. Then they sell the bottom. Once they sell the bottom, the stock recovers and it goes on and it makes new highs. This is what happened on August 5th. This is what happened in 2020. This is what happened in 2022. This is what happened in early 2023 on SVB when people on YouTube were banking experts and they were saying it was the next 2008. It's always retail investors selling the bottom, and it's always institutional investors picking up the stocks, because retail investors don't invest based on logic, they invest based on feelings. And the most important thing about this video that you have to know is that the market isn't rational. If the market was rational, and if the market operates like most of you believe, which you believe if the market or if the stock beats on earnings, it has to go up. If stock doesn't beat, it has to go down. If it's going down 20%, there has to be some news. Or maybe the market knows something we don't know, or the market is telling us something. Not all the time. This is not true. The market isn't rational. And if it was rational, then I wouldn't have this YouTube channel. I wouldn't even invest because there's no opportunities. The main reason there's opportunities is because investors act based on how they feel. They don't act based on logic. They don't act based on research. And if you're acting based on how you feel, you're not taking advantage of others' mistakes. You're the one that's making the mistakes that institutional investors are taking advantage of whenever they're buying stocks on August 5th, and you're selling because we're going to have the next 2008. And this is why the stock market will never ever be rational. And if it was rational, we wouldn't have Warren Buffett, because there's nothing to do. Everyone is smart, everyone knows everything. But this is not the case. And this is what Buffett said. He said, unless you can watch your stock decline by 50% without becoming panic-stricken, you shouldn't even be in the stock market. Why? Because, for example, Berkshire Hathaway went down 50% 3 times. And this is one of the best stocks of all time. It went down 50% 3 times. Now, do you believe the fundamentals have declined by 50%? No. Do you believe their cash position, they likely had a lot of cash even in 2008? The stock went down 50% in 99. The stock went down 50%. It went down 50% 3 times. But they didn't sell a single share. Why? Because they couldn't care about the price. They're focusing on the value. And if you're not focused on the value, if you don't know what you own, you're going to focus on the price, and the market is going to take you from happy to sad, from happy to sad. You're going to sell the bottoms and buy the tops. You're going to do what makes you feel better instead of doing what's right because of the underlying fundamentals. And it's just never going to work out. And it's going to be a very bad cycle. But those kind of sell-offs and the mispricing in the market can get extreme. So if a stock is going down, it doesn't mean the market knows something. And the best example of that is Meta. Meta went down 77%. And this is a $500 billion company. And this is a very good proof to the people that believe that if it's a mega cap and it's going down, it has to be going down because there's a reason, because the market knows something we don't know. This is not always true. The market could make mistakes, and people's emotion can get so extreme that stocks like Meta could decline 77% because they missed 1 or 2 numbers on the monthly active users, and because TikTok is taking over the same reason why I bought Pepsi, because because people said Ozempic is taking over, no one's gonna buy Pepsi anymore, everyone's gonna be skinny, stupid. And I made a lot of money with Pepsi many times on those narratives. But it's all emotions. It's all emotions. It's never on logic. So much that a company like Meta went down 77% on practically not much news other than some CapEx, okay, but it wasn't, they could have pulled back CapEx at any time. And it still went down 77%, then it went up. So if this happens to Meta, if such mispricings and misunderstandings based on people's emotions could happen to Meta, don't you think it could happen to your maybe stock that's a $2 billion market cap that you own, or 200 million or $5 billion? Of course it could. So if a stock is going down after earnings, it doesn't mean it deserves to go down. It doesn't mean the company is a trash company. It doesn't mean the market knows more than you do. It's not always. The market could be making mistakes. Even though there's 200 analysts, even though all that stuff is in place, there's still always mistakes. Why? Because the market isn't rational. And the only way you could be able to take advantage of the irrationality in the market is by taking advantage of other people's mistakes that invest based on emotions and not on logic. And the only way you can invest based on logic is if you know what you own and you know why you own it. This is very, very important. You have to focus on the long-term fundamentals of the company and stop looking for feedback from the market if you're right or wrong. If this is what you look for, then you shouldn't be in stocks. I'm just being honest. And I see it happening all the time. For example, a stock I talked about 2 weeks ago, like Crocs, it went down like 15% on earnings. And people told me, this video hasn't aged well. It's only 11 days old. Don't you believe some kind of mispricing could happen, an overreaction that could be corrected? So this is why opportunities exist in the market, because people invest based on emotions and not on logic. And if you can do the opposite, if you understand how the market works, why Warren Buffett is even an investor, because the market isn't rational. And our job as investors is to take advantage of this irrationality by investing based on logic, because we did our research and we know what we own. And this is the best that I could say for this video. I hope you got some value out of it. I'm not the best teacher ever, but I tried my best. And I hope you enjoyed it. I hope you got some value. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.